Hi, welcome to Investments. Glad to see everybody here. So today I'm going to be doing an introduction for those of you who are not able to make it to live to the first class. And we're going over the introductory materials. This PowerPoint is available on Canvas. So welcome. Glad to see everybody with us. So this is really an introduction to the stock market and investments. So how does this work? We're going to go through different kinds of investments and by and large dedicate an entire class session to each one of these. But it's important to think in whole about the types of investments that we'll be dealing with. We'll talk about common stock. Common stock, every corporation issues common stock of some sort. We have corporate bonds. Bonds are may be issued by a company. It's not required. Not every company is going to be issuing bonds. We have government and GSE bonds. Government being the treasury bonds and other kinds of investments that we use to fund the deficit for our country. And then the GSE refers to government-sponsored enterprises. There are a number of these. The most notable ones are Freddie Mac and Fannie Mae, which operate in the mortgage market, and we'll spend an entire session talking about those. So a preferred stock is something that a corporation can issue, but not all do. Mutual funds are collections of stocks that are professionally managed. Exchange-traded funds are similar to a mutual fund, but have some very important distinctions we'll go over in that session. But why do these all exist? That is, what do they have in common? What they really have in common is they're all designed to stuff liquidity, to put money into something. So in the case of a common stock or corporate bonds, again, common stock issued by a traditional company, a publicly traded company. And that common stock is a way for the company to raise money. So if you buy a corporate bond or you buy a stock, or originally when the stock was purchased, the point is to put cash into the company. They then use that cash to build plants, fund operations, build inventory, whatever they need. They're using that money to really support the business. You're buying it as an investment, but it doesn't exist so you can invest in it. It exists to provide money into the system. Same thing with government bonds. Are there to put cash into our federal government and keep it going. The GSE bonds, particularly Freddie and Fannie, are putting liquidity into the mortgage market. So you never go into your bank in March and say, hey, listen, I've just found a house. I want to buy a house and I'd like you to lend to me and give me a mortgage. They never have to say, oh man, we're sorry, we lent all of our money last month. We don't have any cash. The reason is because these entities, Freddie and Fannie, exist, and they're constantly stuffing money, stuffing liquidity back into the mortgage market. So the reason, as a class, all these things exist is so that we can, so that there's an opportunity for you to put money into the system and to raise money. So really, another way of thinking about this is that investing and financing are two sides of the same transaction. So if I am a company and I need financing, I need cash, I need money to put into operations, to grow, to add staff, whatever I need to do, I can go seek investors, issue stock, issue more stock, issue a corporate bond, maybe even some preferred stock, and get cash into it. So when I talk about financing, investment's the other side of that coin. Now, I know that many of you are taking this as an accounting elective. You've all had accounting, so you may be wondering, okay, well, where is it on the balance sheet that I'm going to see these investment instruments? And the answer is potentially everywhere. It is, if you're a company with a treasury function, meaning that you have money that you're managing over time, you're probably going to have investments. You're not going to stick that money in a vault somewhere. You're going to either put it in a bank where you're going to get at least some interest, or ideally in other kinds of investments where you're going to get a return. So among your assets at any given moment as a corporation may be investment instruments. If you have floated bonds, that is a liability. You owe money to the bondholders, and so your investments, in some cases, depending on your financing, in which to the buyer is an investment, at any given moment may be part of your liabilities. And certainly if you're a corporation, the owner's equity is typically in the form of common stock, that who owns your company, those who own the stock own your company. So stock is owner's equity. In fact, you sometimes see the formula written as assets equal liability plus shareholders equity. So that's the reason in a corporate case, owner's equity really is shareholder equity. So terms to know. These are terms that you may have seen, they may feel familiar, but you may not have used them in the technical sense. We'll be using them in this course. The first is return. Return is what you get back for your investment. So you're investing, you're going to get money back. It could be cash, it could be growth in the value of your investment, it could be any combination thereof. But what do you get back in exchange for your investment? That's what we mean by return. When we take that and express it as a percentage, which allows us to compare one investment to another. So we look at the percentage of the return, that's called the yield, and we'll spend some time talking about that in some detail. What you're venturing other than your money is risk. So what is the risk that you don't get paid at all? You invest in a company on Tuesday, and on Wednesday they go bankrupt and they don't exist, and the value of your investment goes to zero. The risk is essentially what are the chances that things don't go well for you as an investor. When that, and there's a relationship, we oftentimes look at the relationship between risk and return. So if you're taking on more risk, logically you would expect to get a higher return. When that risk becomes uncommonly high, that's when we start talking and using the term speculation. So speculation is simply when the risk and maybe the return is very high, but the risk is also very high. So there's a legitimate chance you may lose everything as part of this. That's when you're getting into the realm of speculation. So speculation is just a term of art that means really high risk. And ideally, if it's something you're taking on, really potentially high returns. An investor is the person who's putting their money in and expecting this return in exchange. In this case, for this class, most of the time, we're going to place you, the student, in the place of being the investor. When a common stock or preferred stock pays you cash, in the case of that's a dividend. In the case of a common stock, it may be something the company declares periodically. They may have a history of giving consistent and similar sized dividends. In the case of a preferred stock, it is usually written into the contract, so you know what the return on the preferred stock in terms of dividend is going to be. Capital appreciation is when something you buy becomes more valuable. So you buy a stock at 20, it's now worth 25. That is growth. That is capital appreciation. So in looking at the return or the yield on a stock, you really have to look at both. That is, how likely is it to go up, or how much has it gone up, and what's the dividend? Because the dividend is essence, you may think of it as them paying you to wait for the value of the stock to go up. So it's something very, very, very valuable. Bull and bear. I'm not sure what the history is in terms of why these particular animals were selected, but we use bull to describe things that we think are going to go up. We're bullish on the market, or we're bullish on a particular stock. Bearish is when we think the market's going to go down, or a particular stock is going to go down. I'm bearish on XYZ company means I think that the value of the stock is not likely to increase, it's likely to decrease. Now, understand that even in the best bull markets where things rising, everything seems to be rising, there are going to be some losers. Some companies going to go down. Same thing in a bear market, everything is predominantly dropping, becoming less valuable. It doesn't mean you can't find some stocks that are going to do very well. So, bull means good, bear means bad in terms of up and down. One of the, your reading for this first class talks about the investment strategy process. Think of it as you're going to have some sort of policy. Just what is it you want to accomplish? If you're talking about, in the case of an institution, you have money you're going to park for a period of time. What's that period? What is it that you want to set? You may also have philosophical positions, that is, you don't want to, or you think it is out of the realm of your brand to invest in liquor companies or people who make weapons or medical systems that provide reproductive care, or maybe even farming if sensibilities of your customers and your values would be against consuming animals. So whatever it is, if you have those kinds of policies, or if you have personal goals, this is money, I'm putting this money here, is money I'm setting aside for a house, so I'm going to want it within the next 5 years. This is money I'm putting for retirement, I won't be touching for many, many years. So what is your investment policy? What's your risk tolerance? How much risk are you willing to take on? Then you analyze and evaluate the investment vehicles. That is, what is it that I might invest in? You formulate a diversified investment portfolio. Understand that sometimes in some contexts in investment, diversified or diversification is seen almost as a universal good. Understand that it is kind of a controversial position. Some investment professionals are of the very strong belief that diversification simply kills the return that you're getting, and in fact, diversification is not a good thing. But diversification of a diversified portfolio revision, have some sort of understanding of when in the process you're going. If you have a stock that goes up, when do you take profits and sell? Measure and evaluate portfolio performance, and then make adjustments as needed. So, brokerage types. What are the types of accounts that you would be using? Well, as an organization, you're going to be using a straight up brokerage account. You're going to have an account with a major brokerage firm, and all your money and your securities are only going to go into there. As a person, you can also have a brokerage account. Brokerage accounts to a person are fully taxable, meaning at the end of the tax year, if you've gotten interest on cash, if you've gotten dividend payments from the company, you're going to pay taxes on those. When you sell a stock and you have a capital appreciation, so again, you buy a stock for $20, you sell it for $25, you're going to pay taxes on that $5, but that happens only when you sell. So it doesn't matter how much a stock has gone up if you haven't sold it. The profit, the taxable incident, only happens once you sell the stock. The other four accounts underneath there are all tax protected accounts. So the first, traditional IRA and Roth IRA, 401k, 403b, and then the Roth 401k, 403b. These are the major types of accounts as an individual that you may have, in addition to the brokerage account. These are all tax deferred, meaning that you're not going to pay taxes on the money until it's withdrawn, typically in retirement. So traditional IRA, this is money that you get put into your IRA and you meet the income requirements. The ability to put money in IRA phases out as your income increases. But if you qualify and you have qualified income, you put money in traditional IRA, and that then becomes deductible on your taxes. So you are essentially not paying tax on the money you put into a traditional IRA. And then when you retire, many, many years from now, you'll pay taxes at your current tax rate then. So the money doesn't get taxed until you take it out. Roth IRA, also a retirement vehicle, but that is after-tax money. So the money you put into a Roth IRA would be money that you've already been taxed on. So you've already paid your income tax on that. So when you withdraw those principal payments in retirement years from now, you will not be taxed again on those. 401k, 403b. There's some small differences between them, but essentially they're the same thing. 401k is an account that is offered by a for-profit company. 403b is a nonprofit. So if you work for Oglethorpe University, for example, we're a nonprofit, so we have 403b accounts. This is an account where you can contribute money, and typically your employer is also going to contribute money. So just note to students, one of the biggest mistakes I see students make is getting into their career and not taking the 401k match. It's free money. Essentially, your employer is saying, I'm going to give you another 3, 4, 5, 6, 7, 10% of your salary for free. So not having this account, not making your contribution, and sometimes it's a match. So you have to put 1,000 in, they'll put 1,000 in, but that's $1,000 free money. So you put your $1,000 in, you get a second 1,000. That's an automatic 100% return just by doing it. So it really is affirmatively stupid to not participate in your company's 401k or 403b account if it's offered as a benefit. Now, this is like the traditional IRA. 401k, 403b is pre-tax dollars. So when you pull the money out in retirement of those accounts, you'll be paying the taxes at your current tax rate at that time. Roth, 401k, 403b, of these, this is probably the least common defined corporations offering. But the Roth 401k, 403b uses post-tax money. So you've already paid taxes on that. Again, there may or may not be an employer match. If there is, you're foolish not to take it or make the contributions you need to get that match. And then when you take it out in the future, your contributions will not be taxable because you've already paid tax on it. So those are the types of accounts. Now, where would you find those accounts? That is, who's going to hide it? Who's going to shelter and hold that account? These are called custodians. So who is the custodian of your account? Traditionally, if you're going to open a brokerage account, it's probably going to be at a major brokerage firm. So your Charles Schwab's, Merrill Lynch's, Edward Jones, those are your types of companies that are going to have places where you can go in and open a brokerage account. You just got to go in, give them, $50, $100, I'm going to open a brokerage account, fill out the paperwork. They will fill it out. You open it just like a bank account. But once it's in there, you've got some cash in it, you can then go out and buy stocks, bonds, CDs, anything really available in the world. Now, you will go and see that most of the major banks have investment arms. So you can go into a city or regions, a Truist, they may or may not be operating under that bank's name, but they will typically have an investment partner where you can open an account. Now, there are also banks that still offer bank IRAs. These are not very popular because the only thing you can really invest in bank IRAs typically is the bank's own CDs. And so to give you more options, you're usually better off going either with a brokerage firm or the investment arm of a bank as opposed to the bank itself. So there are investment firms, typically that have their own mutual funds. So Fidelity, T. Rowe Price, Vanguard, you can open an account directly with the company there, and it's treated like a brokerage account. The only difference is, and it's a pretty big difference, is that unlike with a Schwab or Merrill Lynch, you can go in and buy Fidelity funds. If your money's at Fidelity, it's not like you can go buy other investments. You can only invest your Fidelity money in Fidelity funds. And then there are employer custodians. So there are other companies that some may be household names, some you've never heard of, who will house your 401k, 403b, or Roth 401k, 403b. Here at Oglethorpe, we use a company called Lincoln Financial, and they're the custodian. So I have an account with Lincoln Financial as a university employee. All the university employees have an account there, and that's where our 401k money that we contribute, as well as the university's match, goes into. Now, how safe are these investments? Well, the major brokerage firms are SIPC insured, SIPC, Security Investors Protection Corporation. It is often compared to the FDIC, but it is different in that the SIPC really is designed to support and protect custodianship as opposed to value. SIPC returns the cash and securities, but not necessarily the value you invested them. So if you go and put, $300,000 into a brokerage account at a major brokerage firm, and that brokerage firm goes bankrupt tomorrow, goes out of business. Generally, this doesn't happen. So this is not a common act. But just say for the sake of argument that it did, you would get your stock back. Now, when you get your stock back, it may be worth a fraction of what it was worth before. If you've got your money in an account that's FDIC insured at your bank, and the bank goes under and there's $250,000 in the account, you're going to get $250,000 back. If it's SIPC, you're going to get the securities back. So SIPC protects stocks, bonds, treasury certificates, CDs, mutual funds, money market funds, in certain, really anything that's qualified under, I think it's the 1936 definition of securities, is covered. SIPC does not protect commodity futures contracts, foreign exchange, or certain other derivatives that are not covered. Those are in account, and the company goes under, you're just out of luck. So there is a protection limit. SIPC will insure up to $500,000 in custodial value, which includes $250,000 limit on cash, but that's within the 500. So it's not 500 plus 250 cash. It's 500, 250 of which at a max can be cash. So if you've got 200,000 sitting in a Charles Schwab and 100,000 in securities, and Charles Schwab goes under, which again is not going to happen, then it is it'll be protected by SIPC. SIPC will make you whole. Now, the main way that they are different, the FDIC and SIPC, is FDIC acts more like an insurance company, like your State Farm or Allstate or Geico, whoever has your car insurance or your renter's insurance. They collect premiums from the banks, and if a bank does a run on a bank and a bank can't meet its obligations, they will step in and use those the premiums that they receive to cover claims. SIPC actually asks to see everything on a regular basis. So if a broker is SIPC insured, that means that they're showing the securities to SIPC and the cash to SIPC on a regular basis. So they're saying, okay, you tell me for all your beneficial owners, that is all the investors, you've got X million shares of stocks, show me those stocks that you actually have them. And they have to demonstrate that they have. You say you've got X $1,000 of cash on hand. Well, where's the cash? Show me the cash. Show me the account. Show me where that money is. So SIPC is much more hands-on in terms of making sure that what you're looking for and what you're being protected against are really there. So we talk about markets in general terms, and there are market indices, and these are different index measures of markets. The most common three you hear all the time: S&P 500, Dow Jones, and NASDAQ. Now, Russell 2000 is meant to demonstrate the health of small business. So Russell 2000 is an index of the 2,000 smallest stocks in the Russell 3000 composite. Dow Jones Industrial Average looks at 500 of the largest stocks on U.S. Stock Exchange. The Dow Jones Industrial Average looks at the 30 largest companies on U.S. exchanges. And NASDAQ, which is National Associations of Security Dealers Automated Quotation System, that's cute moniker. NASDAQ is actually a composite of everything on NASDAQ. Since it's wholly electronic, they've been able to simply tell you, okay, in the aggregate, here's how every single stock on NASDAQ worked. So when we talk about NYSE or the big board, we're talking about the New York Stock Exchange. There was another stock exchange, the American Stock Exchange, what people refer to it some years ago, merged into the New York Stock Exchange. So really, the New York Stock Exchange is the dominant stock exchange in the United States. The NASDAQ tends to focus on newer companies. I think the average age of a company on NASDAQ is something like 15, 16 years, whereas the average age on the New York Stock Exchange is probably 50, 60. I mean, you have 100-year-old plus corporations who are still listed on the New York Stock Exchange. Chicago Board of Exchange is a market that focuses on futures, present future values. Future contracts, and so puts and calls. We'll explain all that in just a little bit, but it deals with exchange traded funds and other things that are a little bit different than some traditional stocks. But CBOE is a great market, and as you might guess, it's based in Chicago, so Chicago Board of Options Exchange. So that concludes our introduction. We will meet on Wednesday live and in person and start each individual session on each of the investments mentioned above. And we'll start Wednesday with common stock. It's great to see everybody. Thanks for tuning in.